Most people don't think about emergency funds when markets are calm. They think about them when something small goes wrong at exactly the wrong time. A delayed paycheck, a car repair that costs more than expected, a medical bill that arrives while rent and utilities are already scheduled. What makes these moments stressful isn't the size of the expense, it's timing. When cash flow breaks, even briefly, the financial system you live inside reveals its true shape. That shape looks very different in the United States than it does in Europe. And understanding that difference is the key to understanding how much emergency cash you actually need. Hello, this is Leon Zhao, an independent analyst at Finance Guru, where we don't chase noise, we study reality. And in this video, we will cover emergency fund and how much you actually need. This is a US versus Europe reality check. Did you ask a question? Why the famous 3 to 6 months rule was never universal? The 3 to 6 month emergency fund rule did not come from empirical labor market modeling or crisis analysis. It emerged from post-war assumptions about stable employment, predictable healthcare costs, and long-term employer relationships. Those assumptions described a narrow slice of history, and even then, mostly in the United States. Modern data tells a more complex story. According to the Federal Reserve Survey of Household Economics, nearly 40% of American adults report they would struggle to cover a $400 unexpected expense without borrowing or selling assets. This figure has remained stubbornly high across economic cycles, including after years of low unemployment and rising asset prices. In contrast, surveys across Western Europe consistently show higher short-term financial resilience, not because people save dramatically more, but because household risk exposure is lower. The rules stayed the same. The systems changed. The result is a mismatch between advice and reality. Now let's discuss income volatility, where the US and Europe diverge first. Income stability is the single most important variable in emergency fund sizing, and it is structurally different across the Atlantic. In the United States, employment is largely at will. Employers can terminate workers quickly, often without severance. During recessions, layoffs cluster and spread fast. In the 2008 financial crisis, U.S. unemployment rose from 4.7% in 2007 to 10% by late 2009. During the COVID shock, over 20 million jobs vanished in a single month. Unemployment benefits exist, but they are uneven. Replacement rates often fall below 50% of prior income, benefits are capped, and payment delays are common during periods of mass claims. In 2020, millions waited weeks or months for assistance to arrive. Europe follows a different pattern. Employment protection slow layoffs. Income loss is often partial rather than total. Programs like Germany's Kurzarbeit subsidize reduced hours instead of terminating workers. During the 2008 crisis, German unemployment barely moved, even as output contracted. During COVID, large portions of European labor markets were frozen rather than dismantled. The result is that U.S. households face sharper income cliffs, while European households face income slopes. That distinction alone dramatically changes the amount of cash needed to stay solvent and rational during a shock. Analyzing it from another dimension, that is healthcare costs, the hidden multiplier in American emergencies. Healthcare is where emergency fund math breaks completely from intuition in the United States. Even insured Americans face deductibles, copays, and out-of-pocket maximums that can reach thousands of dollars. Medical debt remains one of the leading contributors to personal bankruptcy. According to multiple studies, unexpected medical expenses frequently coincide with income disruptions, amplifying financial stress. During COVID, millions lost employer-sponsored insurance alongside their jobs. COBRA coverage offered continuity, but at full cost, often exceeding $600 per month for individuals and far more for families. For households with modest savings, healthcare premiums alone consumed emergency reserves before any other expense appeared. In Europe, healthcare systems absorbed most of this risk. Illness created inconvenience and stress, but rarely financial ruin. This single structural difference explains why American households require larger cash buffers even when incomes appear similar on paper. Now, questions is, How long emergencies actually last in real life. One of the most dangerous misconceptions about emergencies is duration. People assume income disruption is brief. History suggests otherwise. After the 2008 crisis, long-term unemployment surged in the U.S. Many displaced workers took years to return to prior income levels. Some never did. Entire industries reshaped. Geographic mobility collapsed as housing markets froze. Households that entered the crisis with thin liquidity were forced into permanent financial compromises. Southern Europe experienced even longer scars. Youth unemployment in Spain and Greece exceeded 40% for years. Temporary government support softened the blow but could not replace lost earning trajectories. The lesson is not pessimism. It's realism. Economic shocks resolve slowly at the household level, even when headlines declare recovery. The behavioral cost of running out of cash. Emergency funds do more than pay bills. They protect decision-making. Behavioral finance research consistently shows that financial stress narrows time horizons. When liquidity is scarce, people accept inferior job matches, sell assets at unfavorable prices, and rely on high-interest debt to bridge gaps. These choices compound long after the emergency ends. During the 2008 market collapse, households with insufficient cash sold equities near market bottoms, not because of pessimism, but because they needed liquidity. Those with adequate buffers were able to wait, avoid forced sales, and participate in the recovery. Cash doesn't just prevent disaster, it preserves optionality. The real cost of holding too much cash excess liquidity has a cost, and history shows it clearly. In Europe, decades of low or negative real interest rates quietly eroded the purchasing power of large cash balances. Overly conservative households paid an inflation tax for safety. In the U.S., long periods of near-zero rates produced similar effects before recent tightening cycles. The mistake is not caution, it's rigidity. Emergency funds should evolve as income stability, asset base, and macro conditions change. Treating them as a permanent static number is the real risk. What the data actually implies, there is no universal emergency fund size. There never was. The correct question is not how many months of expenses you've saved. It's how much time your savings buy you before urgency starts making decisions on your behalf. In the U.S., where income can fall to zero quickly and healthcare costs remain volatile, that time requirement is longer. In Europe, where systems absorb more risk, but not all of it, the buffer can be smaller but still essential. Households that navigated past crises best were not the most aggressive or the most fearful. They were the most liquid relative to their exposure. That ratio, not a rule of thumb, is what matters, the question worth leaving with. Emergency funds are often framed as pessimism. In reality, they are structural realism. They acknowledge that modern economies are efficient, interconnected, and fragile at the same time. They buy patience in moments when patience produces better outcomes. So instead of asking whether you've reached a recommended number, ask something more honest. If your income stopped tomorrow, how long could you remain selective, rational, and calm before pressure narrowed your choices? That answer looks different in California than in Germany, different in London than in Texas, different for a salaried employee than a contractor. And that difference is exactly the point. This is Finance Guru, where we don't chase noise, we study reality.